Welcome back to Market Brain, where we dive deep into the math that makes markets tick. Today, we're tackling a concept that sounds like a tongue twister but is absolutely fundamental to understanding market dynamics: the volatility of volatility. You know the VIX, right? The fear index that tells us how much the market expects to swing. But what happens when the VIX itself starts swinging wildly? That's where things get really interesting, and where the Heston model's vol parameter and its real-world cousin, the VVIX, come into play. Think of it this way: the VIX is like a speedometer for the stock market. It tells you how fast prices are expected to change. A high VIX means a bumpy ride ahead. But what if the speedometer itself is jumping all over the place? What if the expected speed of change is highly unpredictable? That's the volatility of volatility in a nutshell. It's not just about how much the market moves, but how much the market's expectation of movement moves. The Heston model describes how a stock price $S_T$ evolves, but crucially, it also models how its variance $V_T$ changes over time. The first equation shows the stock price, driven by a drift $mu$ and a stochastic volatility term $SQRT V_T$. The second equation is the star of our show. It models the variance $V_T$ itself. Here, $kappa$ is the rate of mean reversion, $HT$ is the long-term variance, and that $sigma$ term? That's our vol parameter, representing the volatility of the variance process. So, what does this vol parameter, $sigma$, actually mean? Imagine the market's mood. Sometimes it's calm, sometimes it's frantic. Volatility measures how frantic it is. But the volatility of volatility measures how quickly that mood can swing from calm to frantic, or vice versa. It's the mood swinginess of the market's mood. A high vol means the market's expected level of future uncertainty is itself highly uncertain. In the real world, we have indices for these concepts. The VIX, as we know, is the market's expectation of future volatility for the underlying index. It's derived from options on that index. But then there's the VVIX, the volatility of volatility index. This index measures the market's expectation of future volatility for the VIX itself. It's like a meta-fear index, telling us how much the market expects the fear index to jump around. When the VIX is already elevated and the VVIX is also high, it suggests a market where not only is uncertainty high, but the level of uncertainty is also highly unstable. Let's zoom back in on the Heston model's variance equation. That underlined $sigma$ term is precisely what we're talking about. It's the parameter that dictates how much the instantaneous variance $V_T$ fluctuates. A larger $sigma$ means the variance process is more volatile, leading to larger and more unpredictable swings in the market's expected future volatility. This parameter is notoriously difficult to pin down accurately when calibrating the Heston model to market data. Calibrating the Heston model to real market option prices is a complex task, and getting a stable, reliable estimate for this $sigma$ parameter, the vol, is particularly challenging. Why? Because it profoundly impacts the pricing of exotic options, especially those sensitive to volatility changes. The paper we're discussing explores 4 different, rigorous approaches to estimate this Heston vol parameter by directly relating it to the observable VVIX index. These methods range from using the known transition density of variance to analytical approximations and even solving the Heston PDE directly. Ultimately, understanding and accurately estimating the vol is not just an academic exercise. It's crucial for financial institutions to properly price and risk manage complex derivatives. When the VIX itself is experiencing significant moves, as we sometimes observe in the markets, having a robust way to model that volatility of volatility allows for more stable and accurate pricing, even in turbulent conditions. It helps us quantify the uncertainty of uncertainty, giving us a deeper, more nuanced view of market risk.